There's a market bubble nobody talks about anymore. Not 2008, not the dot-com implosion. Something older, something uglier, and something that rhymes so closely with what's happening in markets right now that it should make every investor stop scrolling and actually pay attention. When this bubble popped, the market crashed 50%. The world's largest, most bulletproof companies lost 60 to 80% of their value overnight. Inflation ripped from 3% all the way to 11%, and the market didn't fully recover for 8 straight years. 8 years of financial purgatory, and almost nobody remembers it. If what's happening in today's market has been giving you a weird sense of déjà vu, stick around, because by the end of this video, that feeling is going to make a lot more sense. I'm Jimmy, and this is Finance Misfires, where we dig into the money psychology traps and market system failures that keep repeating themselves while everyone swears it's different this time. The story starts in the late 1960s. The United States had just ridden a 20-year economic sugar high coming out of World War II. Factories were running full throttle. Suburbs were sprouting up out of nowhere like acne on a teenager. Americans genuinely believed the country was untouchable. And honestly, why wouldn't they? The US had just beaten Germany in the war, put a man on the moon, and invented the Etch-a-Sketch. Life was good, money was flowing, and confidence was through the roof. From the end of World War II in 1945 all the way to 1970, the U.S. stock market gained over 350%. That kind of bull run doesn't just build wealth, it builds dangerous levels of optimism. Sir John Templeton, the legendary investor who averaged 15% annual growth for 38 consecutive years, warned that the 4 most expensive words in the English language are, "This time it's different." And right there in the middle of that post-war boom, an entire generation of investors was about to find out exactly what he meant. Out of that post-war bull run came an investing strategy that swept Wall Street like wildfire. It was called one-decision investing, and the concept was dead simple. Find the companies so dominant, so deeply embedded in American life that the only decision you ever needed to make was to buy. Never sell, never second-guess. Just hold forever and collect. These stocks became known as the Nifty 50, and we're not talking about some sketchy penny stocks or early-stage tech gambles. These were bona fide blue-chip American institutions: Coca-Cola, McDonald's, American Express, Xerox, household names that had already proven themselves across decades of economic cycles, companies that your grandparents trusted, your parents trusted, and now Wall Street was telling you to trust with your entire portfolio. Investors treated these stocks like they were literally immune to gravity. The idea of ever selling any of them wasn't just unpopular, it was considered flat-out crazy, financial suicide, the kind of move that got you laughed out of the room on Wall Street. Here's where it gets ugly, and this is the part that should make any investor paying attention today deeply uncomfortable. By the early 1970s, the Nifty 50 stocks weren't just expensive, they were priced like the laws of financial physics simply didn't apply to them. The average price-to-earnings ratio for the broader market at the time sat at a reasonable 15 times earnings. Normal, healthy, the kind of number that doesn't keep you up at night. But the Nifty 50, the never-sell darlings of Wall Street? Coca-Cola was trading at 46 times earnings, Xerox at 49 times, McDonald's at 86 times, Polaroid at 90 times earnings. On average, the entire Nifty 50 basket was sitting at a jaw-dropping 42 times earnings. And if that concentration wasn't enough to set off alarm bells, at the peak, the top 5 Nifty 50 stocks alone accounted for roughly a quarter of the entire U.S. market. The full group of 50 stocks made up nearly 45% of the total market. Nearly half the entire U.S. stock market, sitting in 50 stocks, all priced like they could never go down.
Jesse Livermore, the pioneering speculative trader who made his fortune shorting markets during crashes, put it plainly when he said there is nothing new on Wall Street. Whatever happens in the market today has happened before and will happen again. He wasn't wrong, he was just a few decades early. And then 1973 arrived, and it didn't knock politely. Here's the thing about markets built on blind optimism. They don't crack slowly. They don't give you a polite warning and a chance to reposition. They hold together right up until the moment they absolutely don't. And then everything comes apart at once. That's exactly what happened between 1973 and 1974. Oil prices didn't just rise, they quadrupled. Inflation that had been sitting at a manageable 3% ripped all the way up to over 11%. Unemployment doubled, climbing from 4.5% to nearly 9%, and President Nixon effectively dismantled the gold standard for good, pulling the last remaining anchor out from underneath an already destabilized economy. The stock market fell 50% between 1973 and 1974, the worst bear market the United States had seen since the Great Depression. And when an economy falls apart that hard, overpriced stocks don't just correct, they don't pull back to fair value and stabilize, they get obliterated. The one-decision stocks, the bulletproof blue chips that sophisticated Wall Street money had been piling into for years, got absolutely wrecked. Coca-Cola shares dropped over 60%, McDonald's fell over 70%, and Polaroid, the stock that had been trading at 90 times earnings like it was printing money forever, collapsed more than 90%. 90%. Gone. The so-called safest stocks in America turned into one giant financial obituary, and the investors who had been told these companies were untouchable found themselves buried under losses they hadn't even considered possible. But here's the part that really stings, the part that turns a bad situation into a genuinely devastating one. This wasn't a clean, sharp crash with a quick recovery on the other side. There was no V-shaped bounce, no Fed swooping in with emergency liquidity to paper over the damage in 6 months. It took the market a full 8 years, all the way until 1981, to crawl back to the levels it had been at before the bubble popped. 8 years! Think about that for a second. If you were 35 years old and fully invested in the Nifty 50 at the peak in 1972, you were 43 before you broke even. That's not a market correction, that's a financial prison sentence. And what made it so devastating wasn't just the math, it was the mindset. These investors weren't reckless gamblers throwing money at meme stocks, they were following conventional wisdom. They were doing exactly what the smartest people in the room told them to do. They bought quality, they held forever, they tuned out the noise, and they got absolutely wrecked anyway because they confused the quality of a business with the fairness of a price. That distinction right there is the entire ballgame, and it's a mistake that a whole new generation of investors is lining up to make all over again. Mark Twain never actually said history repeats itself. What he said was that it rhymes. And right now, if you're paying even half attention to what's happening in today's market, you should be hearing one hell of a rhyme. Because back in 1972, the Nifty 50 made up nearly 45% of the total U.S. stock market. Every dollar you put into a broad index fund was essentially a leveraged bet that those 50 companies would somehow grow into the absurd valuations the market had slapped on them. Fast forward to today, the plot is identical, the effects are just shinier. The Magnificent Seven, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia now account for roughly 32.5% of the entire S&P 500. 7 companies carrying the weight of the whole market on their backs like it's completely normal. If that concentration feels uncomfortably familiar, it should. And just like the Nifty 50 before them, the Magnificent Seven are priced like gravity is strictly optional.
Google trades at 18 times earnings. Meta trades at 25 times earnings. Amazon at 40 times. Apple at 31 times. Microsoft at 28 times. Nvidia at 25 times earnings. And Tesla, the one that should make every value investor's eye twitch, sits at 200 times earnings. Are these incredible businesses? Absolutely. Nobody's arguing that. But so was Xerox, so was Polaroid, so was Avon Products back in 1972. All dominant, all innovative, all trading at prices that assumed the good times would literally never end. And every single one of them got absolutely wrecked when reality showed back up uninvited. The Magnificent Seven have become the modern version of the one-decision stocks. Investors are treating them as if there's only one move: buy and never question it. The same psychological trap, the same dangerous concentration, the same bedtime story being whispered across every brokerage account in America. These companies are untouchable. They'll grow forever. This time, it's different. There are those 4 words again. Here's what nobody wants to say out loud. The Nifty 50 bubble didn't pop because the companies were bad. It popped because the macro environment shifted in ways nobody had fully priced in. Oil shock, inflation surge, monetary policy upheaval, a series of external dominoes that the market had been completely ignoring, right up until it couldn't anymore. And right now, rates are elevated. Inflation is still sticky in places it shouldn't be. Geopolitical pressure is building, and the Federal Reserve is navigating a tightrope that has very little margin for error. We don't need an exact repeat of 1973. We just need a couple of those dominoes to fall. And then, overpriced doesn't just mean expensive anymore. It means exposed. Warren Buffett once said that what we learn from history is that people don't learn from history. And here we are, again, staring at a top-heavy market, waving off valuation concerns, and whispering the 4 most expensive words in the English language like they're a financial strategy. This time, it's different. It never is. And the investors who understand that, the ones who study the failures instead of just celebrating the wins, are the ones who don't end up trapped in an 8-year financial purgatory wondering what the hell just happened. This is exactly what Finance Misfires is built to cover. Not the hype, not the headlines, the patterns, the psychology, the system failures that keep repeating themselves while everyone looks the other way. If this video made you think differently about where your money is sitting right now, share it with someone who needs to hear it. Subscribe if you want more content that actually challenges how you think about markets and money. Drop a comment. Are you seeing this same setup in your own portfolio right now? I'm Jimmy. Don't let the 4 most expensive words cost you 8 years. I'll see you in the next one.